Crypto is everywhere, on TV, in politics, in banks, in headlines. Yet most Americans still don't own any. How is that possible? If adoption is real, why does ownership stay so low? And why does this gap feel bigger every year? Let's dive in. Here's the part almost no one mentions. Roughly 70% of Americans still don't own any crypto at all. Not Bitcoin, not Ethereum, not XRP. That number hasn't collapsed overnight. It stayed high for years, despite headlines. No judgment here. Just a fact most narratives quietly skip. And it feels uncomfortable because it contradicts the mainstream story. If adoption is real, this creates tension. Apps are everywhere. Banks talk crypto. Politicians debate it. Yet ownership barely moves. So the real question isn't hype versus hate. It's why awareness keeps growing while participation stays limited. That gap is exactly what this video explains. And understanding it changes how you interpret every crypto headline today. Crypto adoption did increase in the United States. Ownership rates today are higher than they were years ago. More people opened accounts. More platforms launched. Regulation became clearer. That progress matters. But adoption doesn't move in straight lines. It advances through cycles, pauses, and resets over time. This pattern appears across every major financial technology shift. Growth rarely looks exciting while it's happening. Crypto adoption comes in waves. Rapid surges attract attention. Quiet plateaus test conviction. Then progress resumes later. Those flat periods feel like failure to observers. In reality, they're how new systems digest previous growth before expanding again. This cycle repeats across technology, finance, and infrastructure adoption globally over time. Seeing crypto everywhere doesn't mean most people own it. Awareness spreads faster than commitment. News exposure is passive. Ownership requires action, risk, and responsibility. Many stop at curiosity. They watch prices. They read headlines. But they never cross the line from observer to participant. This gap explains why ownership lags far behind visibility for most people. The US is one of the most crypto-exposed countries globally. American markets dominate headlines. US exchanges shape liquidity. Policy debates influence narratives worldwide. That visibility creates the impression of mass ownership. But leadership in attention doesn't automatically translate into widespread personal participation. Exposure and ownership follow very different adoption curves over long periods of time historically. In many countries, crypto adoption is driven by necessity, inflation, currency controls, limited banking access. People adopt because alternatives fail. In the US, the system mostly works. Crypto becomes optional. That difference alone explains why adoption looks slower, despite massive awareness. When survival isn't at stake, participation requires a much stronger motivation than curiosity alone provides. Being early or visible doesn't mean being widely adopted. The US leads crypto conversations, not ownership depth. Markets can dominate influence without involving most citizens. This happens with stocks, bonds, and private equity too. Leadership creates awareness first. Participation follows much later, and only for a fraction of the population. Crypto is not breaking this rule, it's following it. Crypto feels simple from the outside, but once people look closer, complexity appears fast. Wallets, keys, networks, fees, security. For many Americans, this feels unnecessary and risky. When something looks complicated, hesitation replaces curiosity. Most people don't reject crypto because they hate it. They step back because they fear making irreversible mistakes. Volatility excites experienced investors, but it repels everyone else. Sharp price swings feel dangerous, not opportunistic. Most households prioritize stability over upside. When something can drop fast, people imagine regret before profit. This fear dominates decision-making far more than potential gains. For the majority, avoiding stress matters more than chasing returns. That instinct alone keeps many Americans out. When faced with uncertainty, most people choose inaction. Doing nothing feels safe. There's no regret, no responsibility, no learning curve. Crypto requires active decisions. That alone filters out the majority. Even when curious, many postpone indefinitely. Not because they decided against crypto, but because they never decided at all. Inaction is powerful, silent, and extremely common. Access is no longer the problem. Americans already have everything needed to buy crypto: apps, exchanges, banks, ETFs, and regulated platforms. Yet most people still don't act. What separates the 30% who did isn't intelligence or luck. It's the fact that they viewed crypto as optional risk. Money they could afford to question, not money they needed to protect. Despite easy access, ownership barely moves. This surprises many observers. But convenience doesn't eliminate fear or uncertainty. People delay when consequences feel unclear. Crypto still feels optional, experimental, and personal. Without urgency, hesitation dominates. That's why adoption doesn't explode just because friction drops. When action carries responsibility, most people choose comfort instead. This isn't ignorance, it's human behavior. More information doesn't automatically create confidence. In fact, it often does the opposite. The more people read, the more risks they discover. That leads to analysis paralysis. Crypto education spreads faster than conviction. Understanding something intellectually isn't the same as trusting it personally. This gap explains why knowledge increases while ownership stays flat. Learning is passive. Commitment is emotional. Most never cross that bridge. Crypto isn't mandatory. No one needs it to survive in the US. Bills can be paid. Savings exist. Banks function. That makes crypto a voluntary risk, not a necessity. And optional risks behave differently. People engage only when upside feels clear and downside feels manageable. Until that balance shifts, most will stay out by choice. Not because crypto failed, but because comfort didn't. The vast majority avoid risks they don't need. And for many Americans, crypto isn't necessary to survive or function. But the 30% who entered saw something different. Not certainty, asymmetry. A chance where downside felt manageable, and upside uncertain, but meaningful. They didn't enter because crypto felt safe. They entered because ignoring it felt riskier. Not owning crypto isn't always passive. For many Americans, it's a deliberate choice. And entering crypto is not an act of confidence. It's an act of tolerance. The 30% who bought accepted volatility, uncertainty, and long time frames. They didn't expect clarity. They accepted confusion. Staying out feels safe. Entering feels uncomfortable, but intentional. No serious asset reaches universal ownership. Not stocks, not gold, not real estate. Even the most established markets involve minorities, not majorities. Crypto feels different only because it's new and visible. Expecting universal ownership misunderstands how financial systems evolve. Adoption never means everyone participates. It means enough people do. Crypto isn't lagging. It's behaving normally for a financial innovation. Awareness spreads fast. Ownership never does. Most people hear about new assets years before they engage. This gap exists in every market. First comes discussion, then curiosity. Only later does commitment appear. Crypto is deep inside this awareness phase. That's why conversations feel everywhere while ownership stays limited. This delay isn't failure. It's structural. Understanding arrives long before action ever does. Historically, most individuals only invest once uncertainty disappears. They wait for safety and social proof. But the first 30% accept ambiguity as the entry cost. They don't wait for comfort. They wait for understanding. This is why early ownership is never about being early in time, but early in comprehension. The crowd follows clarity. The minority moves before it. Nothing about crypto adoption breaks historical patterns. It expands unevenly, slowly, and emotionally. Early phases feel confusing. Middle phases feel controversial. Mass participation comes only after structure feels boring. That's the moment most individuals finally feel safe enough to join. Crypto hasn't reached that stage yet, which explains why ownership remains limited despite constant exposure. The process isn't stalled. It's unfolding exactly as expected. 70% staying out doesn't signal rejection. It signals selectivity. Financial systems don't need universal participation to function. But the 30% who entered made a different choice. They accepted uncertainty early, knowing clarity comes later. This gap isn't about intelligence or courage. It's about how people relate to risk, time, and discomfort. Adoption is often misunderstood. It doesn't mean everyone joins. It means participation becomes sustainable. Crypto adoption isn't about reaching 100%. It's about reaching the right percentage, enough to support infrastructure, liquidity, and long-term use. The rest arrives only when necessity replaces curiosity. Until then, partial adoption isn't a weakness. It's the natural state of every evolving financial system. In the US and everywhere else, the real divide isn't between owners and non-owners. It's between those who understand and those who react. Crypto doesn't reward blind participation. It rewards clarity, patience, and perspective. Owning isn't mandatory. Understanding is. If you want to explore the world of crypto, don't chase miracles. Educate yourself. Because in this world, a simple click can change a life. But only knowledge can protect your future.